Hello, this is Ilya Cobi from Cobi RE Team at William Ravis, and today I'm here with our loan officer, Bob Flynn, and as always, Bob is gonna bring us some news about interest rates. At the same time, we're gonna talk about a very important topic, about credit score.
Yeah, credit score is everything, and thanks for having me today, Ilya. So, credit scores, there's so many different thoughts and reactions to credit scores in the marketplace, and clients really don't have the information correct. Credit scores, when we do a mortgage credit score, it's a hard credit. So we're pulling from all three bureaus, and just to give you an example of what that is, Experian, TransUnion, and Equifax are the three bureaus that are really the only deliverer of correct credit scores in the country. So we hear FICO scores, and that's directly related to Experian. That's what they call their in-house credit scoring system. TransUnion has Empirica, and Equifax has a Beacon score. So we use the lowest borrower of all borrowers on a transaction, middle score, to actually price a loan out for Fannie Mae and Freddie Mac.
Yeah. Bob, what is a minimum credit score that someone must have to qualify for a mortgage?
Great question. So that it depends on the program, right? We can do a VA loan for somebody with a score of 580, and they don't have the effect that maybe a Fannie Mae or Freddie Mac will be, because they will tier their pricing based on somebody's credit score, that lowest middle score for the borrower. So somebody that has a 620, which you must have a 620 or higher to do a conventional loan, Fannie Mae and Freddie Mac, but your pricing is going to be much higher. You may not be able to do a no-point loan if your scores are around 620 to 640.
Yeah. And what does a credit score affect? Does it affect, let's say, the affordability of a buyer, or does it affect the interest rate?
Yeah, the rate, Ilya, that's everything. And that works into affordability too, because, the higher rate, the less the qualifying characteristics for that borrower, so they borrow less. And again, they may have to pay points in order to obtain a rate, and the rate is going to be much higher. Picture something on a giant Excel spreadsheet, and each client is going to fit somewhere different on that Excel sheet based on credit score, type of property, down payment by 5% increments. It's all over the board. So you really need to get a professional like me to run the scenario before you even go out shopping.
And because I ask this question because sometimes I have a buyer that says to me, hey, my credit score is 750. I can buy anything, the bank can lend me.
Right. And that's a great point, right? Because we have these startup companies like a Credit Comma, not to pick on them because there's a few of them out there, but they're not worth the paper that they write it on to give to the clients, because we don't recognize that type of credit score in the mortgage industry. So and that's the same with anything you're buying. So if you're out buying a car, they're going to do a soft credit, meaning they'll pull one of those threes, the Experian, TransUnion, or Equifax, and run with that score. But with mortgages, we're doing a hard credit. We're doing all three for only the three bureaus that are recognized, and taking the middle score of that lowest borrower. So that's important for clients to understand, that those third-party credit offerers are useless to us.
Yeah, because sometimes you have someone with 750, then he has a 725, or
a 680.
680, so you're always going to take the middle one.
That's
725.
That's right. And all three of those credit companies, they don't share their algorithms. So they're running their own systems, which is why you can have a variety of scores. and differing scores. And some of the creditors out there will only report to one of those three bureaus, although they often share their information. That's not always the case. So they'll vary on credit scores based on what is reported, which is why they'll take the middle of the three scores just to make sure they're doing an average.
Yeah, and when we have two buyers, let's say someone has a credit score of 780 and the other one has a score of 740. I mean, how this loan will be qualified?
At the 740. So it's the middle score or the lower of the 2, 3, 4, 5 borrowers. Whoever's the worst, they're going to use that score, unfortunately. The other thing is we hear all the time is, people don't want to run a hard credit because somebody else maybe had run it recently. And that's such a misnomer. It was created by the banks years ago to get clients not to shop.
Yeah.
And we encourage clients to shop. So somebody that's applying for a mortgage and has a hard credit pulled, 50 times within a 30-day period, it doesn't affect their scores at all. The first pull will maybe affect them by a couple points, but it doesn't change anything for them. And then subsequent pulls, it's the way the companies that's doing the pulling reports it. If it's for mortgage financing, then you can have as many as you need to in order to do your correct shopping. If it's for auto, it will show as auto. If it's for retail purchase, it'll show that. So, that will change based on what type of credit you're having pulled. But, I encourage people to shop. It doesn't affect their scores.
Yeah, so, if you're a buyer and then sometimes when I refer a buyer to a different lender, they'll say, oh, I'm going to pull my credit. So they're afraid that
that is correct. And so they shouldn't be, because again, that's a misnomer. The government encourages people, the Clear Lending Acts are encouraging people to go out and shop and make sure that you're comfortable using the lender you're working with.
Yeah, good. And what would you say will be like maybe 3 things that can help someone improve their credit score?
Yeah, that's a great question. I'm glad you brought that up. It wasn't even on my mind. So one of the things that negatively affects a client and they don't realize it, they might have perfect credit. But if you have a credit line that's $2,000 and your outstanding balance is $1,500, over 50% of the available line, even if you're paying it off at the end of the month, it's when we pull. And it's when that company reports. That will negatively affect you pretty dramatically. So I always encourage clients or, future clients to make sure that they don't run credit balances over and above 50% of their available credit at any time. And that's usage. Again, I don't mean, if you're paying it off at the end of the month, great, but it's when we pull. So if you decide you're going to Hawaii and you have a $10,000 line and you use $8,000 of it and we all of a sudden pull at that point, that's going to negatively affect you pretty dramatically. You'd be surprised that, 20, 30 points you can lose just by that scenario. So I always encourage, if you're going to use a credit card and you're running balances each month, make sure that, you have a high credit limit. So, have those banks increase them for you and try to stay under it. So use multiple cards if you need to do that.
Or you use another card.
Yeah, so that's right. But especially if you're looking to have a mortgage done, if you know that you're at a high balance, write a check, make sure that, it's reported as paid down before you have your credit run. That's very important.
Thank you, Bob. This was a very, very valuable information.
Welcome, Ilya.
And if you want to know more about your credit score, how to improve your credit, or you are ready to apply for a mortgage, please get in touch with us, with me and Bob, and we'll get you to the right place with the best terms.
Yes, with the best information available. Right.
Thank you.
We can put the puzzle pieces together very quickly.
Thank you.
Thank you.